The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Tech. My name's Gaurav, and joining me today is analyst James Carlisle. Good day, James.
Good morning.
And with us also from Vancouver is Graham. Graham's an analyst too, for those who don't know. Good day, Graham.
Hey, Gaurav.
Gentlemen, we've just finished reporting season. It was one of the more difficult reporting seasons that I've come across over the last few years. I don't know about you guys, but we've actually summarized. Turbulent.
It was horrible. I've got to say, it was one of the worst I've had for a while.
Okay, well,
mine started off poorly and then got better.
No, I actually, it was probably look, the results themselves were pretty good, but I was surprised by the negativity from management, and I don't think the future's going to look all that good, actually. We've summarized some of our thoughts in an article on the website, so if you want more detail, you can check it out there. But I thought today we could just go through some of the important results in a bit more detail. So we've each bought around one or two stocks each, and I thought we'd do a round robin and just go through them and discuss, ask questions, and see what we thought. James, since you were the analyst on probably the crappiest result of the entire season, I thought we might begin with you, and I think we all know what we're talking about here.
I think this is one of the worst results for a couple of years.
For a couple of years.
Of the ones I look at. I mean, look, there are bad results around the place, aren't there? But this was a howler. And it's sorry, we're talking about Domino's Pizza.
Of course, yes, we're talking about Domino's.
It really gave cause to question the quality of the business, and it's unusual that one result sort of does that. Because we've previously regarded it as a pretty high quality business, not just because of its management. Management is always a little bit, weak. If management's your only reason, management of Domino's has always been very good, but it has also a lot of things in its favor. We like particularly the fortressing strategy, where they build out a very dense network of small stores, relatively small stores, which gives them an advantage in terms of delivery. Pizzas are also naturally a good food to deliver. They deliver well. And so in the sort of fast food delivery space, we've thought they had a few advantages. But yeah, this result really called that into question. And mostly because of the manner of it. I mean, the speed with which it fell off the cliff. So it wasn't really a bad half that they had. They had not even a bad month. It seems like they had a bad week at the end of December. So they raised a bit of money, and they put out an AGM notice at the end of November, and then raised a bit of money at the beginning of December. Don May, the chief executive, even bought some shares. He sold some recently, I think 7 or 8 times as many. So that seems like a small fry now. But so they, at that time, they were saying, look, earnings are going to be, roughly in line with last year's period, give or take. Well, take 7 million of forex headwinds. So earnings were going to be slightly lower. In the end, they came around about 20% lower, which is, a hell of a surprise. And a hell of a surprise since they were, advising, all of that happened in the space of a few weeks. And as I say, I mean, in Asia, management said they had a pretty good Christmas, and Christmas is a very important period for Asia. But it all fell off in the last week of the year. And it makes you wonder a bit what was... how that can happen, and probably the answer is that to shore up franchisee profits, really. So they, there's a high operational gearing in these businesses. They have high fixed costs, so when sales dip slightly, profits can disappear quite quickly. So the company's been sort of supporting its franchisees a bit by holding on to some of those cost increases in key raw materials, things like cheese and wheat, particularly, But the franchisees have also been struggling with higher labor costs. And but anyway, so Domino's has been holding on to a lot of those cost increases essentially. So when a lot of volume starts going through, they're wearing a lot of losses. The final period, December is a relatively big month for them, so I suppose that can have a disproportionate effect. But it just calls into question a little bit the value proposition. When I'm used to looking at high quality businesses, and we'll look at another one of those in a moment. Car sales is the one I'm going to draw a parallel with, but they experience cost increases, and they have a very easy time of passing those on to people.
It sounds like Domino's was doing that by not passing those price increases on by choice, though, wasn't it? The management
that's right.
consciously decided not to. So it hasn't been tested whether they can push the price increases onto the customers.
Oh no! I think it has been, well, because they're trying to. So it's a question of the sales. So the sales, the sales took a turn for the worse for the franchisees in December because they got the pricing. So they changed prices sort of around October. Introduced some new, try to put prices up. Again, and this is all part of helping the franchisees to make money. It's all part of a delicate balance. And what they said is it takes a couple of cycles for you to really know how well that's done. A couple of sales cycles. So someone orders a pizza, and they think, next one they think, geez, that cost me so much. And they think, well, okay, that's all right. I'll go back, and you order it again. And then the third time you sort of think, actually, I'm not sure I want to be paying that. So, the first, it's not as if people immediately, because once you're going onto the app and you want a pizza, you're not about to sort of withdraw and say, actually, I won't have a pizza tonight because it's $2 more expensive. But by the third time, you're beginning to think about, maybe I go up the street and pick one up from someone, save myself that money.
It would have such an effect, the price increases, because it's not as if groceries and people's alternative options weren't going up as well in price. So they still would have been deciding whether or not to have that pizza based on all their other expenses.
That is right.
Has the value to the customer changed much?
Well, I don't think so, but I think so. What it is that they say that they're getting it wrong. That's what they put their hands up, and this is what you expect from Domino's management. They're very in the past, they've always been pretty candid. And they said, look, the industry is doing fine. So burgers, particularly, they said, were doing well. But that's more of a sort of drive-through or takeout option rather than delivery. And even the overall delivery, well, the delivery is doing worse than takeout. But they underperformed relative to that. And they think they just got their pricing strategy wrong. So there's a myriad of different sort of specials, and you get vouchers, and there's delivery fees, and so it's a very complicated way that they sort of try to charge you. They try to lure you in with offers, and then then sell you add-ons which are better margins and that sort of thing, and they think that they just got that wrong. And so that's part of their strategy for fixing it. But it all sounds a little bit, it's hard to give it much, have that much confidence, really. I mean, that may improve things. They've introduced a bunch of what they call flexible vouchers in Australia, which have been doing apparently quite well in sort of January, February. But hold on, they just said that it took 2 or 3 sales cycles to know. So, going by that reckoning, we can't really be confident about that either. So
it was the map of the of the result for me rather than the content of the result itself. They just raised capital, didn't give any hints that there was a slowdown in sales. And
I don't think they had any hints. I believe them about that.
Isn't that worse? That means there's been a sudden change.
Yeah.
And
I think
that's unlikely to be over now. I mean, if it changed on a dime in December, it's probably still.
Oh no! They said
turning.
that January, February had started pretty badly as well. But they've got hopes for these flexible vouchers. The new app in Australia, they've got various sort of reasons why things might improve.
But then Don May sold a whole bunch of stock.
Well, he sold a bunch of shares.
Yeah, that was such a bad look.
$8 million worth. Yeah. Well, look, I don't know how much, the reasoning given was to take a conservative stance towards his personal debt. It's always a bit of a worry when people are borrowing. I mean, I'm look, it's his own personal finances. He can borrow what he likes, but it's hard to know what to make of that. But what it does tell you is he doesn't think there's any obvious reason why it's suddenly going to go up in the next few months. So look, he's taking a conservative view, and his view is presumably that the share price could do a lot worse in the short term, which naturally it could. I mean, there's people buying and selling the stock. The people who are selling the stock at the moment think that
It's always a warning sign for me when management sells a stock that's fallen a long way. I wouldn't mind at all.
I think if you borrowed a lot of money against your holding, then you kind of have to. And look, it's hard. I mean, look, it's definitely not a good sign.
Yeah.
I don't know. I would say it's not as bad a sign as the speed with which profits evaporated in December, and likely have continued to stay evaporated in January and February. So it just, I prefer to see companies able to control their own prices. The argument with Domino's was a little bit like, during a recession, pizza's a pretty cheap option, so people keep buying it.
Well, that was the evidence during the last downturn. That's in fact what happened in the last downturn. So this seems to be, whatever's happening now seems to be different to what happened last time.
Well, I think what's happened is a big dose of inflation. I mean,
inflation,
and they've had to hold on to it, and I dare say they're still holding on to it in January, February, and so they've withdrawn guidance for the second half earnings, and if you get 6 months of earnings problems instead of just 1 month, although it was a big month, that is going to. So look, I will. We don't want to upgrade this, so we've taken the price guide off it. I think it's. We do have a lot of faith in management. They've earned that over the years, and it has bounced back from some poor periods in the past, and it has shown in the past. In fact, it has quite volatile earnings. There are halves here and there in the past where this sort of thing has happened. Not quite to this degree, but earnings are volatile. They can get things wrong, and their experience is that if they tweak it and experiment and get it right, then things can turn around pretty quickly. And that's what they're saying is going to happen. I hope so. But I think that the business deserves a bit of faith. So we have it as a hold, but we've removed the price guide. We're not going to be wanting to upgrade it until we've seen that final result, and until we've got a little bit more clarity on how all this has happened, and where those losses lie. Whether they call them warehouse losses when they're sort of taking the brunt of the price increases. And so how much of that, and it's also going to slow down a bit of the growth as well, because if franchisees are seeing that that's partly why they have to shore up the franchisee profits, because they rely on their best franchisees buying up franchises from the poorer operators and expanding, and they're not going to want to do that unless they can see some profits there. So on a sort of medium term basis, it calls into question their forecast for store rollout. So it's in a difficult spot. Look, the shares fell 25% on the day, and they're down another 5 or 10% since then. So the market's down by a third since the result. So the market's taken a lot of this on board. And I guess it's in the naughty corner. and we're just going to, watch and wait, really. And I think that's for lazy. I say lazy. Lazy is a very good thing when you're investing. For long-term, patient investors, I think hold is the right recommendation. But keep an eye on your portfolio weightings. I think it's got a lot riskier. That's definitely something to mention. And we put up our risk ratings at the time of the result and reduced our maximum portfolio weighting to 5%. As long as you weren't ahead of that before from 6%, then you're unlikely to be now. So hopefully that's fine for people. But I mean, I also said in the article, more aggressive people who manage their portfolios more aggressively might choose to, if they've got better opportunities, or they can use the capital loss. It wouldn't be crazy to sell and see what happens.
Although it is still up from the first time we upgraded it, James. I might add that it's not a. Yeah, we still haven't lost for those of us.
Yeah, well, for those who got it then, but we've had buys. I mean, I had a buy. Well, you said the first time we upgraded was 5 years ago or something, but
was that 5 years ago? Really?
Well, something like that. But I upgraded it last year at $84.
Okay.
So people have lost money since then.
Yep. So there's definitely capital losses. Yeah.
It was a big mistake. We had a sell price 150, I think, early last year, when it got up to 165-ish. And I was just, it was a time when you were just selling things was difficult because they kept going up, and I'm kicking myself.
Right. That was one of the lessons from the madness. I think we all in the team did really well avoiding some of the tech bombs that have subsequently blown up. But I think the big lesson, certainly for me, has been selling, and we think we've lost the art of selling over the last decade.
Yeah. Well, it's been difficult because
it's been really
things
hard.
have just been going, and you look stupid. And
for 10 years, the right answer has been don't sell. To any circumstance, and the right answer has been don't sell.
That's right. So
and that's suddenly changed.
Look, at least we weren't buying it up there, but geez, it would have looked smart if we'd have sold it. There we go. That's
every cycle provides its lessons. And I think selling is the lesson from the last cycle that certainly I've learned. But I'm glad we didn't get caught up in any of the buying madness in any case, because there was some crazy stuff going on over the last 5 years in particular. And at least we've learned one thing, which is not to get caught up into that. Then the second lesson, I guess, is learning to sell at the right time too. I'm still learning it, JC. I don't know about you guys.
Yeah, well, for sure. I think this is a good example.
It's a good example. Yeah.
Anyway, let's move on.
Let's move on. Yes, let's leave Domino's there. We might give you a bit of a break, James, and we'll come back to your second stock, which I think is quite interesting. But Graham, how about you? Did you have a stock you want to discuss in a bit of detail, maybe a bit less detail than what James went into with Domino's, perhaps?
Well, I think probably the best result that I had come out this season was Cochlear's one.
Okay.
Just because I think that the part that impressed me the most was firstly their acoustics division, which usually gets barely a mention in their reports. It's only a small slice of the overall business, but it did really well. So it's gone from a much more competitive situation compared to Cochlear's normal implant division.
What does the acoustics division do, Graham?
So the acoustics division, it's still a type of implant to improve hearing, but it works in a different way to the typical cochlear implant, which is through an electronic pulse. The acoustics one works through bone conduction.
Oh, I see. Like those toothbrushes that play music as you brush your teeth.
Okay, you got fancier gadgets than I do.
Not entirely like that, though.
I do.
Oh, right, okay.
But I'll have to check that out.
Yeah, these I haven't got one myself, I hasten to add, but I've seen them. And it's an electric toothbrush, and everyone in my family uses electric toothbrushes. But this one, it plays music through your teeth. So it vibrates a frequency, and you hear the music, I think, in your head, or you hear it somehow, and it goes through your teeth. But
Okay,
I
Cochlear's got a whole new business line lined up for
Yeah,
that.
right.
Watch
that's
out for the
a buy.
Cochlear too.
Soon they'll be streaming phone calls to your teeth, and
Yeah.
it already boggles mind that they can stream phone calls straight to your brain through the
Is that right? Is that a thing? Is it?
Yeah.
That's
Yeah,
amazing.
I
Wow.
mean, I can get it sounds crazy, almost like you're in a what's it called? I don't know, some sort of fairy tale, but someone can call you from the other side of the world. Your phone picks up the call. It then sends it by Bluetooth to your cochlear implant, which then plays it straight into your brain.
Wow.
So without any sound passing through, you can get a phone call from the other side of the world. How is that not magic?
That's telepathy, isn't it? It's scientific telepathy. It's amazing.
Yeah, people wouldn't believe it 100 years ago.
I barely believe it now, to be honest. It sounds incredible. But sorry, go on.
Stuff.
Go on with
anyway, the good thing about the result in particular was that their cochlear implant division, which is that section, the one that does the typical routing through your brain, that part there had implant sales go up by 14%. This is usually a business that grows in the low single digits. But for that to jump so much was quite impressive. And also because although there's going to be some effect from last year where we had lockdowns, a lot of the regions that they were selling them in last year didn't have those kind of issues. So I think that was a pretty good result overall. It wasn't as exaggerated as some other results that we'll probably talk about were because of that lockdown effect. So the good thing about having implants go up so much is that it then leads to another 20, 30 years worth of sales through upgrades, through accessories, through battery changes, all that kind of thing.
That's a good point to make, Graham, that every dollar of sort of hardware revenue is actually backed up by many, many dollars of sales and service and future revenue as well, right?
Yeah. And in Cochlear's case, it really is locked in. That if you get a cochlear implant, it's inside your head. You are not changing brands. And that means that you are then kind of locked into these perpetual upgrades. So, which are backed by insurers as well. So you don't even have to pay for them in many cases. But anyway, that's the good thing about having the implants jump so much this year, is that it shows a long lead of growth ahead for the company.
Yeah, right.
It's my favorite number to watch. So yeah, Cochlear did pretty well.
It's been a long time since we've had a buy on Cochlear. Are we any closer after this result?
Well, yeah, we've been closer to selling in a lot of cases.
Yeah,
but
that's right.
Kind of like your example before, it was always a mistake to sell, basically. In this case, we're closer. Well, we're probably midway through the price guide. I think we've got a buy of 160 and a sell of 280, and the price at the moment is around 220 or something like that. So we're maybe a little bit closer to buying than selling, but it's kind of midway. It's and it's hard for a business like this to really get to a screaming undervaluation anyway, because everyone knows it's a great business. It's just got so many competitive advantages, and so yeah, those kind of businesses just don't end up that cheap.
Yep. No, I understand. Yep. Well, I'll talk to my best result as well, which wasn't really a contest for me. I mean, the coal guys had amazing numbers. Some of the miners had fantastic numbers, but for me, the best result was really from Lovisa. And Graham, you sort of hinted that there have been some lingering COVID impacts, and that was clearly evident in the Lovisa result. I had these crazy same-store sales growth, which was historically completely out of whack because of a comeback of customers into the store. But even if you strip that out, revenue growth has been extraordinary. And what really astounded me, and I think probably excites me most, was the extent of the store rollout. I think the market generally has been quite conservative with store rollout numbers. And there's been a shift in the way this company looks at store rollouts and how aggressive it's prepared to be with store rollouts. So they rolled out 86 stores in 6 months, and that just is insane. And I think they're actually looking to accelerate that rollout from there. So they're sort of looking at 200 stores a year. And I don't think that's factored into the prices at all, because if you do any sort of math on that, it just you're looking at a potential explosion in earnings if it all works out. And there's obviously no guarantee it does. This is, of course, a discretionary retailer, which is the dodgiest riskiest part of the market where we've seen many companies blow up, many ambitions thwarted. But this seems pretty special to me. I think this is looking quite interesting for me. It's still a really good idea, and the market I don't think quite appreciates the change that's happened. When I listened to or actually read through the transcript of the results, I mean, that was the big thing for me. Just the change in mood from management. They are suddenly more ambitious and more aggressive, and you don't see that in the numbers straight away. They're certainly rolling out very quickly, but I think you'll start seeing that over the next few years as those stores open and as they mature. And they're doing all of this while paying a 3% dividend yield. They're not in then their net cash. I just haven't seen a retailer growing its store network in this way without tainting the balance sheet before. So this is quite special what's happening here in Lovisa, I think.
Do you think they'll be getting to a point soon where they kind of saturate their market? They've just rolled out too many stores and the stores start cannibalizing each other or something like that?
No, we're only at 700 stores, Graham. I think that there's thousands of potential stores they can open. And part of the strategy is actually to open in high volume locations. They actually double up and they fortress the stores. So if you notice in Melbourne, in the CBD in Melbourne, there are 2 stores sort of 100 meters away. In the QVB, there are 2 stores about 40 meters away, and they're both very profitable. So it's something that the site selection is something that they're quite strict with, and they're very good at. They close stores down very quickly when they're not working. And the beauty of the model is that the store costs are actually quite small. So it's a low footprint, low labor business model, and it works really well opening and closing stores quickly.
Well, and they have negative working capital, don't they?
I don't know if it's quite
negative. Okay.
Yeah,
so they do have to invest a little bit,
yeah,
but they don't. Not other specialty retailers have to invest a lot more as they expand their footprint, don't they? I think.
Well, the inventory, the working capital is actually it's not negative, but it's clearly not burdensome either, because they can fund it internally. Which brings us back to you, James. I
was just talking about being able to grow without sucking in too much cash. That's the online classifieds for you. That's any of these big sort of software companies which have, their costs are in their profit and loss account. Their investment is mostly in their profit and loss account. And once they're rolling out their product, any extra sales doesn't really fall to the bottom line. So that puts them in a very strong position for growth, and grow they have been.
Extraordinary businesses, aren't they?
Yeah, they're fabulous. But I mean, if you're the best, if you're the number one, I think,
yes, that's right.
If you're the number 2, not so much. And if you're the number 3, forget it.
Forget it. Yeah.
So, they really are. And obviously in this country, I'm talking about REA, car sales and Seek. And I could pick any one of those as an interesting comparison to Domino's in this reporting season, particularly in terms, well, it's not just that growth, but also in terms of their value proposition and the value that they deliver and the ease with which they can pass on cost increases. And they all were demonstrating that in the latest reporting, in their latest results, with what they call yield going up. So the amount of revenue that they make per listing on their site. And, that gets supported by 2 factors. The first of which is price increases. And the second of which is the mix. The greater proportion of premium products. So, on REA, on all of them, you whether you get a picture or a video, or whether you come to the top of the search results or whatever it is. So they can people pay for the higher premium products. Agents pay subscriptions for having a higher product. In the case of REA, and dealers in the case of car sales. And car sales and Seek particular, well, REA has already gone somewhere down this path, which is the dynamic pricing, which is
were they the first in the world to do that? Because that's quite brilliant.
I don't know whether they were first in the world, but I mean, they're first in this country, I think. I mean, it's where this naturally leads, because you want the people with the fanciest homes or the fanciest cars in the highest demand areas to be paying a bit more, because you want the price that people pay to be reflecting the value that you deliver. And in a very competitive, car buying environment, you're delivering more value than in a very uncompetitive car buying environment. So this dynamic pricing has really been driving car sales and Seek the last couple of years, and it was very evident in this result for car sales in its private segment. But I mean, look, so were price increases. Price increases are a funny thing, because I mean, they're kind of mixed in, because they talk about price and mix, and the mix is the depth products. They talk about the premium products, but really the two things are sort of kind of combined, because you put the price up because of the value that you're delivering is increasing all the time. So that, I think the base proposition for all these companies has increased greatly over the years, but they're also able to sell more of these premium products. So the bottom line is that the revenue keeps marching upwards. They have very strong margins, so the revenue keeps marching upwards, and there's a degree of operational gearing in that as well. So even for REA, I mean, look, earnings are going to fall for REA this year. Because listings have been going down, but it's a huge, buoyancy aid, I called it in my review. The yield that they have on each of those listings. So earnings will fall by a lot less than the listings, we'd expect them to recover nicely next year.
Can I just ask you about REA for a second? The management there spoke a fair bit about the Indian operations, and they were, I was surprised how bullish they were about them. Do you share that bullishness as well?
Well, look, it's a very big country. I mean, look, that's really the size of it from their point of view. Okay. I suppose, that's what they talk about as well. I suppose the key thing about India is that they've gone from being the second or third or fourth even in the market a couple of years ago to being comfortably the leader now in terms of audience. Okay. So they've done really well in that respect, investing heavily into the platform there, housing.com, and in fact, they're stepping up. So they're doubling down. They're stepping up the investment. And that is actually a large reason why earnings this year are actually going to fall a bit. In fact, possibly more than Australian listings. I was just thinking about that when I said it. I mean, the earnings are going to be down a bit this year because they are investing heavily into India. But, having taken that number one position, I would expect them to hold on to it. And it is a big country. It's a huge opportunity for them. It's moving increasingly online, all that sort of thing. So yeah, I think it's a great opportunity, and I back them to make the most of it.
What's the valuation at the moment on REA? Do you know off the top of your head?
In terms of P, is about sort of 40 times this year's earnings, I think.
Oh, okay, so that's still up there.
I'm looking, and but it's that's so after this. So this year earnings falling maybe 6%. That's these are consensus estimates I'm talking about, but they're expected to grow in the high teens next couple of years. Okay. As they think that this year is going to be the peak of the Indian investment. So. That 40 times comes down quite quickly to probably 30 times over the next couple of years, and then keeps coming down after that. I would estimate. I would expect. That makes it by far the most expensive of the three companies, but I think it's the highest.
Deservingly so.
Yeah, deservingly so. Seek's probably the next. So Seek's on low 30s. and car sales currently a P of 30, which is falling. I mean, it's going to grow this year. It's going to grow next year.
Is there an argument that there's been more cyclicality in car sales? We've seen what's happened to these used car prices, and I think car sales, they probably make more money from dealers?
It's been an odd environment the last couple of years because used car prices have risen, but the amount of inventory, people are desperate for cars because you can't buy new cars because of supply chain problems and everything, and everyone wants second cars and they're not giving up the second cars because of the pandemic, because they don't want to be on public transport, all these things. So used cars have been much in demand, which is the point I think you're making. And so prices have been high and inventory has been low, and being the equivalent of listings. But what's happening right now is, in fact, they're in a bit of a sort of sweet spot where prices seem to still be high, and yet the inventory is now recovering, and the leads that they're delivering to dealers is recovering. So that activity is recovering, and yet the used car prices still remaining quite high. And I guess that reflects the fact that new cars are still, they're still trying to ramp back up, I guess, with those. So, look, I think there's an argument for that. I think there's an argument that the next couple of years, but prices seem to have plateaued, and let's not forget we've had all this inflation. So maybe that continues.
The manufacturers say that there's been a step change in the production costs of new cars simply because everything now is either electric or hybridized, and it just costs more money. So all the big manufacturers are saying that we're never going to see a sort of $30,000 base car again, and the average, the mean price of vehicles in Australia is now, I think, 60,000. The US, it's more like 40,000. So it's hugely rising. It's probably a multiple of 2 what it was sort of 5 or 6 years ago.
Well, so look, there you go. So that's kind of supporting them, and of course they've just launched a capital raising to buy out or another third or so of Web Motors in Brazil, taking them up from 40 to 70% of that, and that's quite a growth market. They're getting good growth in the US through Trader Interactive, which is focused not on the usual car market. So you've got to think about them a bit differently. They're not they're a long way off the leader in auto classifieds in the US, but they're very strong, and they are the leader in like RVs and caravans.
Oh, I see. Okay.
And power sports, jet skis and motorbikes and things like that. So they're in a good. The question for Trader Interactive is whether you think that Auto Trader, the leader in the US, is able to take its audience into those markets, or whether they're genuinely separate markets. And I think that the evidence at the moment is that they are separate. People tend to go to them. It takes a different approach slightly to sell an RV than a Lexus. And so I think it's going well. They're increasing yields, they're putting price increases through, and going very well.
I like it, James. It sounds good. That REA particularly sounds quite interesting. I'm hoping this cycle, when we get a shot at finally buying, it's been years since we've upgraded REA.
Oh, well, no, it hasn't. No, we upgraded last year. We had a quick,
very short.
It wasn't that short, I don't think. Yeah, well, we just upgraded a little bit early. We upgraded about 110, 12. Yeah. And then it fell into the 90s, but it was still a buy at that point.
Completely missed it, JC. Yeah, it's one I've really wanted to buy for a long time. I've completely missed it. Yeah. You bought some? Yeah.
I did, yeah.
Nice one. Graham, how about you? Something that maybe... Oh, actually, I won't prompt you. You tell us which stock you want to talk about. It can be good or bad.
Well, you could have prompted me anyway, but I'd end up finding a way to the stock I want to talk about.
Save you the hassle.
Yeah. The next one on my list would probably be CSL.
I could have used the high quality thing after all. Yes, okay.
Well, stick to the quality end of the market. CSL had another good year where it's had a real shining this year because it had a lot of issues coming through the pandemic where it's another high quality business, very well known, everybody loves it. But during the pandemic, it was unable to get blood plasma to make its different antibodies and blood products. Because with the lockdowns, people just weren't able to get to its collection centers, mainly in the US. But since then, that's all opened up. They managed to get plasma volumes to a new record level. So it's recovered fully from the downturn during the pandemic. And that you can think of the plasma as being the hay or the fodder that it collects throughout the year, which it then uses to. Yeah, that's a great comparison. Mm-hmm. This is what they use to process actual products. So when you see the plasma collections going up, it's a really good sign that in the future you're going to see more products able to be made out of it. And particularly with a lot of its products where they're vital to people staying alive, or they're in huge demand where they can't keep up with the demand for them, then having that recovery in plasma is really important. So good to see that CSL's out of the woods on that.
Few questions for you about CSL, Graham. Firstly, I believe they have 3 big drugs in different phases of approval, and each of those drugs, I read, could be $1 billion business on its own, which is just extraordinary. Is that your view as well, that there's a lot of latent potential still at close to $300?
Oh, yeah, for sure. Not only because those particular products are getting towards the later stages of the approval process, in particular CSL 112, which is the cholesterol busting drug. The
cholesterol one, yeah.
That's probably their best shot compared to all of the other ones. And so far it's done very well in their trials, so I'm optimistic for that. But those products will eventually, 30 years from now, roll off their patents and everything and probably lose their value too. But what keeps value inside CSL is that it's got the structures and the research teams and particularly this plasma supply, which allows it to manufacture the drugs that it researches very cheaply. It's all of those internal structures which are what keep it going. It's not whatever drug is being approved this week or next year or anything like that. It's the processes, the systems, the intellectual property. That's what's backing it.
That's a fascinating insight, actually, because I think most people think of CSL as this R&D machine, but everyone knows it's a high quality business. But I don't think it gets credit for being a very strong culture as well, and that's clearly evident. I mean, how many times have we seen a CSL management CEO kind of move on, and we've all been so impressed with the replacement? There seems to be a very strong bench in senior management, and the accounting treatment of all that huge R&D budget is so conservative. It just seems I'm always, every time I come back and look at CSL, I'm so impressed with the management and the way they speak and act and the way they treat shareholders. And I have to pinch myself to realize this is actually a $100 billion business, and there's not too many.
And a 100-year-old business, which you don't get too often. So
you don't get big companies acting and speaking that way often outside of Berkshire.
Yeah, and I would say that it does have a strong internal culture, which you can tell through little things like, compared to a lot of other pharmaceutical companies, which are out there buying research instead of doing the research themselves. They'll have a research budget, but a lot of that is being spent on research coming out of universities or startups or things like that. They're not the ones actually doing it. They're looking for that. And that is competitive, because then when they're buying that research, they're having to compete against the other pharmaceutical companies which are doing the same. So the prices then to actually buy the intellectual property have sucked out a lot of the profits that they might have otherwise made if they did it internally. CSL, on the other hand, does a lot of its research internally. It's not out there buying it from others, which is maybe a remnant of its roots in CSIRO or something like that. But yeah, the Australian culture of research and its researchers locally are top notch, it seems.
Yeah,
they keep finding new stuff in the plasma. So
now, did we actually? Did I completely miss an upgrade of CSL, or has that not happened for a while?
No, that's the one stock on my list that I have never upgraded, but has
Okay.
always wanted to. It's it always looks overvalued, but at the same time, it just continues to beat expectations, mine in particular. So
I've got so much
yeah.
affection for that business. It was I remember when I first joined Intelligent Investor, that was the first stock I bought, as first recommended stock I bought, that I had recommended. And I was working here and speaking to the analyst about it. And I was just, it just sounded fantastic. And I'm still holding it all those years later. I think I've held it now. That's my longest holding in my portfolio. It's been,
and how long is that?
Fantastic. No, more than 10 years.
10% of its history.
Yeah, for 10% of its history. Yeah, it's a wonderful business.
Yeah, we're not too far off an upgrade. I mean, it's 280 or so at the moment, and we have a buy at 250. So it's probably closer to an upgrade now than it's been in 10 years.
Yeah.
When it was getting down to the 60s, I was thinking, oh, good, we're going to get that elephant gun loaded, ready to fire.
A bit like Cochlear, what you mentioned earlier, this never looks cheap. You sort of have to swallow the big multiple when you buy it. And that was the case when I bought it all those years ago. It was on 30-something times earnings when I bought it, which back then was an extraordinary multiple to pay.
Yeah.
So
still today.
And still today, after what, more than 10 bagging, I think, in that time. So it's been extraordinary. The final business I thought we'd talk about, and this might break the pattern of both of you speaking about ultra high quality businesses, but there's a lot coming out of NextDC in their result, and the numbers themselves, I guess they were okay. There was nothing wrong with the financials. There was a few things I saw in the commentary and in the operating numbers that just made me a bit more cautious about NextDC. I've been quite enthusiastic about it for many years. It's been a former buy reco. I think it's been in the funds, in and out of the funds for a little while. We don't own it. I don't own it personally at the moment, but the case there is really that these big data centers, I've called it like a mini Westfield. They attract huge anchor tenants, these hyperscalers, the Oracles, the Amazons, the Microsoft, and in order to get physical server connections to those hyperscalers, it then attracts a whole bunch of other customers as well. And once you start getting a mix of customers inside a data center, the connection possibilities grow, and you end up with this little supermarket of connections, and that drives earnings for decades. I think I mentioned before, but the Equinix is the market leader in the US and in their data centers that are fully booked and matured. They still get almost double-digit earnings growth every year just from more networking, CPI increases, and cost increase, and higher loads going through. So it's a business that can grow effectively for a long time. Churn rates are really low, really strong competitive position. But I've just been a little bit nervous about this huge capacity buildup we've seen. And the competitors and NextDC themselves are both building frantically to get customers in, because once you get them in, it's very difficult for them to move. They have to actually physically shut down their servers, get someone to cart them out and replace them. And that's obviously not going to happen very often at all. In fact, across the industry or across the world, the only people who move are companies that go bust, or if there's a security breach or something. It's a rare occurrence to see customers churn in this industry, which makes it a very strong incentive to grow quickly and get them in there as fast and as cheaply as possible. But they're having to do a few strange things now. So they're now moving into these edge centers, which are small, low returning data centers close to capital cities, but they're in demand from their customers. So they sort of have to have them to strengthen the network. And then they're building these wholesale data centers, which are in demand from the hyperscalers. And again, low returning, they don't have those network potentials. And this is a more of a classic a storage unit for servers. There's one or two customers who sit in them, pay wholesale rates. There's no connection fees. There's no networking. those are also not ideal. So you've got great returns being earned in the primary centers and then being allocated into these edge and wholesale centers where returns on capital are low, but they're required in order to get your customer happy and to strengthen the entire network. So to me, that's a bit of I can't see an alternative but to spend that CapEx, but it does mean that incremental returns are probably falling. And I think there's a bit more cyclicality in this whole industry than what we've come to expect over the last 10 or 15 years, because the results coming from the American cloud companies have been awful. They're clearly cutting back on cloud spending, and that has to hit regional data centers at some point. So I'm a bit worried about that as well. And the third thing I'm worried about is just this enormous balance sheet. I mean, they carry a huge amount of debt, and the debt is backed by property, a huge property portfolio, valuable property portfolio. But we've just seen what capital markets can do, and I think you want to be careful about how much exposure you have to highly indebted businesses at this stage of the cycle. So
have they taken the debt on just recently at the higher interest rates, or did they lock it in years ago? And when that resets, they're going to be hit by all these extra financing costs?
It's resetting already. The financing costs are up about 50% in the last result, and they're only going to climb from there. But they're not in trouble at all. There's plenty of cash from which to pay their debts, but it just increases the risk. And there is such a huge pipeline of growth and there's no indication they're slowing down. So they're continuing to take on more debt and to build out that pipeline at a time where there might be a cyclical slowdown from the demand side. So
presumably they can put up prices quite easily if the debt gets more expensive. That's the question. Yeah.
It's really hard to do, actually. They have really attractive CPI index price increases that go through every year.
Oh, okay. So they get inflation, but
they get the inflation, but the actual there's a lot of competition to get new users. So in fact, one cheeky thing they do, which also doesn't impress me too much, is they capitalize the discounts they give to their initial customers, and then they amortize those discounts, which I just don't think should be done at all.
Well, that's they're long-term contracts, right? So you could. I think it's
they're
okay
not contracts.
They're not. So they can leave at any time, but they just expect that they're going to stay for 10 years or whatever. So they amortize over 10 years.
Correct. Oh no,
how do they capitalize a discount?
Yeah, I've never seen that before either. I was really surprised myself. I mean, they're not huge numbers we're talking about, but there's just one extra little worry on top of a growing list of worries for me. And this is not to say I'm panicked about it. I'm not worried about it. This is an outstanding quality business with a great track record. But I just think we need to be a bit more cautious. So I've chopped back that buy price a fair bit, and I think we want it to cover existing data center capacity only, and we want to pay nothing for the growth. And you've got a lot of property value embedded there as well. So I think that's fair. I'm quite happy with where that price guide is at the moment. But just a heads up that I'm a bit more nervous about this than I was a couple of months ago.
Is there a market for that property?
Oh, yes.
Or are they?
Private equity would be salivating. Infrastructure funds would be salivating. These are fantastic assets. So the game for PE or for an infrastructure business, and this has happened internationally, would be to purchase NextDC or make a deal to buy the property and have these long-term leasebacks. You create this.
Yeah. Why don't they spin off the property portfolio and just?
Yeah,
they lack control of it. That's the thing, didn't they? They did have a vehicle, didn't they? What was it called?
They did do this in their early growth phase. They actually did sell the property to fund the construction of their data centers. Because remember, these things cost $150 million each to build. So to fund that early on, they did used to sell the underlying property. It was called. I remember I pitched it, and you guys knocked me back.
Yeah.
Before it soared.
Oh yeah, and then it got taken. Well, then they bought it back. That's right. And then they bought it back, so it would have been So
they bought it back, and what they said at the time. I'm talking to you, JC, in particular. At the time, what they said was that they bought it back, and they don't spin off property anymore because the long-term customers actually feel more comfortable with them holding the property. So it's a clear indication that customers want to be in there for decades, and they don't want to risk tenancy with someone else. But I think with rental agreements that can be overcome. I don't think that's a game changer. But it is
Probably a good sign that their customers are pushing back on that. Yeah.
Really good sign.
It means the customers know they're going to be there forever.
It just means that there's always going to be, I think, a takeover interest in the business because there's such strong property value. And there's no doubt that an infrastructure or superannuation fund will pay a huge amount. I mean, I consider these on par with the towers, and the towers are getting 30, 35 times EBITDA. And I think you could very easily pay that for property and structure the deals to get release billions of dollars of value if you wanted to do that. So I don't want to be negative about the stock too much, but just I think when you're talking about buying it, there has to be an adequate margin of safety, and that margin is actually shrinking right now. So it's not the time to run off and be aggressive with your purchases on a business like this. Right, gents, shall we wrap it up there?
Call it.
Let's call it. Okay, well done. Reporting season's over. I think I've got one left to cover, which has been haven't actually published it yet. But it's
what stock is it?
It's Illumina. It's done, but I just haven't had we got looking for a day we can put it in. James, I think you're all done as well, aren't you?
Woolies and Coles. I got Woolies and Coles.
All right, that doesn't really count. We all know what's going on there.
Yeah, there's they're great businesses, and they trot along. Yeah. And
Graham, in typical Graham fashion, you're probably the first one to finish.
Yep, I don't have any. What's it called? Any stocks left? They're all. Yep, they get their reporting over and done with early.
The most organized member of the team by far.
Yeah, definitely that.
All right. Well, we'll get on to some ideas, and we'll do this again. James, thanks for joining me.
Pleasure.
Graham, thanks to you.
Thanks, Gaurav.
And for everyone else, thank you for listening.